Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know First Fed's December rate cut odds plunged from 95% to a 50-50 coin toss amid a hawkish internal rebellion. So we'll discuss why this open power struggle is creating a credibility gap and what it means for future market volatility. Second, Trump administration makes a stunning reversal on food tariffs, cutting duties to fight soaring beef and coffee prices. We'll explore how this pivot to a-la-carte protectionism reshapes US trade strategy and its impact on global supply chains. Third, US air traffic controller shortage becomes a systemic crisis as a government shutdown triggers a mass retirement wave. We'll analyse why this brain drain is now a systemic risk, forcing flight cuts and fueling hard-to-control services inflation. Just 1 month ago, a December rate cut from the Federal Reserve was a 95% certainty for the markets. Today, that bet is a total coin toss. A while back, we warned that a shutdown-driven data blackout could upend those odds. That's a big piece of what's hitting today. The odds have collapsed to just 50-50, sending a jolt through Wall Street. You know, these odds aren't just guesses. They come from a market-based indicator called the CME FedWatch tool, which analyzes futures contracts to gauge what professional traders are betting on. We previously analysed how futures-based odds can swing fast when guidance loses credibility. This is one of those moments. This rapid collapse highlights what analysts call a growing credibility gap. So the thing is, the Fed's public guidance is losing its power to anchor market expectations, which means we could be in for more surprises and volatility ahead. The answer isn't just in the data, it's in a growing rebellion inside the Fed itself. Continuing our last discussion about the Fed's widening split, Federal Reserve Chair Jerome Powell is now facing what one analyst calls an institutionally perilous moment. A hawkish faction of Fed presidents is breaking ranks, openly challenging the idea of another cut. Boston Fed President Susan Collins, in an uncharacteristically blunt statement, declared a relatively high bar for additional easing, citing stubborn inflation. She's not alone. She's part of a growing group that includes the presidents of the Kansas City, Cleveland, and Dallas Feds, who are all signaling deep reservations. And these public disagreements are more than just drama. Interestingly enough, open dissent within the Fed historically serves as a direct indicator of policy uncertainty. Believe it or not, we recently saw a rare dual-direction dissent where one member voted for a bigger cut while two others voted for no cut at all. This kind of split shows just how deep the divisions are, making it harder for Chair Powell to build the consensus needed for clear and predictable policy. This internal conflict is exploding at the worst possible time. The recent government shutdown means key economic data has been delayed, with the White House press secretary admitting some October reports may never be released at all. As we previously analysed, when the agencies that publish the jobs report and CPI go dark, the Fed is forced to lean on noisier proxies like weekly jobless claims, raising the odds of a mistake. And even when the lights come back on, some of the economic loss is permanent. You can't replay cancelled trips or recover lost productivity. The Fed is essentially flying blind. And making policy without data is, of course, incredibly risky. The Fed could make a huge mistake in either direction. It's a high-stakes gamble. They could cut rates thinking the economy is weak, only to find out later that inflation was actually roaring back. Or they could hold rates too high for too long, accidentally tipping a slowing economy into a full-blown recession. This is exactly the flying blind risk we warned about a while back. The very definition of a policy error. This has left Chair Powell trying to build consensus and, in the words of one strategist, stave off uprisings on his own board. One potential compromise being floated is a hawkish cut. This is where the Fed cuts rates just once to appease one side, but simultaneously signals that this is the end of the easing cycle to satisfy the other. This kind of compromise can be a policy trap. It might create a short-lived market rally before investors realise there's no more help coming, leading to another sharp sell-off. The fear isn't just about a policy mistake. It's that the committee could break apart deeply and publicly. As a result, stocks are slumping and treasury yields are climbing. The market is no longer just reacting to economic numbers. It's reacting to an open power struggle at the very top of the Federal Reserve, where the next move is anyone's guess. The global implications are huge. If the Fed pauses its rate cuts while other central banks continue to ease, it would likely cause the US dollar to become much stronger. A stronger dollar tightens global financial conditions and impacts the competitiveness of exports as US and European goods become relatively more expensive compared to Chinese goods. And as we noted a while back, this uncertainty doesn't just move markets, it seeps into households, chilling spending before any rate decision even lands. Speaking of unpredictable policy and its impact on inflation, President Trump just hit the emergency brake on his own tariff policy, announcing a stunning reversal by cutting duties on key food imports. This isn't a minor tweak. It's a direct response to soaring prices at the grocery store. What we're seeing is a pivot to what some experts are calling a-la-carte protectionism, and this shift has some major implications. The situation presents a fascinating duality. On one side, the administration is easing tariffs on consumer goods, especially from Latin America, to fight inflation at home. On the other, it's maintaining high tariffs on industrial imports, particularly from China. This signals a strategic shift, prioritizing short-term domestic political concerns about prices over a single, uniform, protectionist ideology. This two-tiered approach is reshaping global supply chain incentives, and for Chinese-speaking audiences, this is a crucial trend to watch. The reason? A perfect storm hitting American households. Let's start with beef. Uncooked beef prices have skyrocketed, jumping as much as 18% year over year. This comes as the US cattle herd has hit a near 75-year low, and key suppliers like Brazil were being slammed with effective tariff rates topping 75%. Producers have been warning about policy whiplash, making it impossible to plan. Actually, this concept of policy whiplash is more than just a catchphrase. It has a real measurable economic impact through what economists call policy uncertainty. There's even an index for it that tracks how often news articles discuss economic ambiguity. When this index is high, businesses get nervous. For cattle ranchers, this makes them hesitant to expand their herds. Why invest for years down the line if a sudden policy change could wipe out your profits? It's a self-defeating cycle. And it's not just your steak. The price of ground roast coffee hit a record high of $8.41 per pound, a staggering 33% increase from the prior year. Prices saw their largest jump since the 1990s after the administration imposed a 50% tariff on Brazilian coffee, a country that supplies roughly a third of US imports. Then there's cocoa. Even after a recent sell-off, futures are still more than double their pre-pandemic levels. The confectionery giant Hershey reported it was facing up to $170 million in tariff expenses this year alone. That cost was passed on, with retail chocolate prices surging nearly 30% just before Halloween. Now, get this. For commodities like coffee and cocoa, where the US has little to no domestic production, simply removing tariffs may not be enough to bring prices down significantly. The main driver of these price spikes, it turns out, isn't trade policy, but massive global supply shocks, think extreme weather in Brazil or disease affecting cocoa harvests in West Africa. These global issues show the limits of using trade policy as a tool when Mother Nature is in control. This all marks a dramatic pivot for a president who has long insisted that tariffs are necessary. Now, facing political pressure, the administration is exempting a range of products like coffee, bananas, and cocoa. It's a clear acknowledgement that the pain at the checkout aisle became too high to ignore, but don't expect to see prices drop at the grocery store tomorrow. After all, there's a significant lag. We need to watch two key indicators, the Producer Price Index, PPI, and the Consumer Price Index, CPI. The tariff cuts will lower costs for importers first, affecting the PPI, but it takes time for those savings to trickle down to you. The ongoing focal point will be watching the gap between these two indexes to see how much of the relief actually reaches consumers' wallets. While the administration tries to manage supply chain costs with one hand, another part of the government is creating a massive supply shock of its own. A recent government shutdown didn't just cause a few travel headaches, it directly impacted the travel plans of more than 5 million people. But that's not the whole picture. The real crisis it exposed is systemic. Even before the shutdown, the US was already short 3,903 fully certified air traffic controllers. Staffing was so thin that many were already working 6-day work weeks. This shortage has evolved from a chronic labour issue into a systemic risk indicator for US infrastructure. In fact, investors and economists are now looking at this number not just as a staffing problem, but as a sign of politically induced failure in a critical system. It forces them to price in the risk that political fights can shut down essential services. Then the shutdown hit. Controllers were forced to work without paychecks. According to Transportation Secretary Sean Duffy, the crisis hit a tipping point. Retirements, which normally happen at a rate of 4 per day, suddenly surged to between 15 and 20 people per day. The system was bleeding its most experienced personnel at an unprecedented rate. And the severity of this brain drain can't be overstated. Air traffic control is a highly specialised, non-substitutable role. The training and certification process can take anywhere from 1 to 4 years. So when an experienced controller retires, their knowledge is lost for a very long time, creating a long-term capacity ceiling on a critical economic artery. The fallout was immediate. The FAA ordered airlines to cut flights, and cancellations spiked to their highest rate in over a year. Bank of America estimated the shutdown delivered a $150 to $200 million hit to the operating income of major airlines. Here's where it gets interesting. These FAA-mandated flight cuts act as a direct, non-market-based revenue cap on the airlines. It fundamentally changes their business model. Instead of focusing on growing passenger volume, they are forced to pivot to margin optimization. This could accelerate a split between premium business travel and a degraded, more expensive economy service. And even if you're not flying, this is a classic non-monetary supply shock that could affect your wallet because persistent flight cancellations effectively reduce the supply of available seats. When supply goes down and demand stays high, prices tend to go up. This could fuel what economists call sticky services, inflation, complicating the Fed's efforts. The reaction from industry leaders was furious. American Airlines CEO Robert Isom told employees, "Only a few other events come to mind when we think about this level of disruption." Delta CEO Ed Bastian was even more direct, stating, "The thing we don't like is being a political football." When we place the US system's vulnerability alongside the structure in Europe, the root cause becomes clear. Many European air traffic control systems are structured as private or semi-private corporations, funded directly by user fees. This model provides a stable financial environment, insulating them from political budget disputes and highlighting a structural weakness in the US system. The conflict reveals a fragile system caught in a political crossfire. So what's next? In the near term, we can expect continued pressure on flight schedules and potentially higher fares. The focal points to watch will be the FAA's monthly staffing reports, any further government funding negotiations, and the airline fare component of the monthly CPI reports. As one airline executive who remained anonymous put it, "We were the pawns."
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.